So in open enrollment this year, pilots are seeing a little different option for life insurance. Under the Delta open enrollment, you'll find a GVUL, Guaranteed Variable Universal Life Policy, in addition to the traditional Delta term policy. Both of these policies have the exact same death benefit next year of around $1,060,000 a year, which is based on the captain's highest pay at times 2,500. So this number won't change whether you choose the group term or this new version of the life insurance. What is different is the GVUL policy premiums are less costly than the group term premiums for Delta, which means that you'll have a little bit of savings on your income tax return. Not like an earth-shattering difference, but it does make it worth switching from the Delta group term over to the GVUL policy. Now, this is where, if you look at the Metlife information, they're very detailed in what your tax savings potentially could be. The chart sits around $180,000 a year as an example. I don't think there's any Delta pilot making $180,000 a year anymore, thank goodness, but ultimately we get the point. So the more you make, the older you are, the more savings there is on using the GVUL policy. Now, that's when the information kind of breaks down, because then they say, oh, it's better to save tax deferred. This is an investment vehicle as well as a life insurance vehicle. And that's where we separate from this is a great policy to no, this is not an investment policy. So your investments and your life insurance should be two separate things. They should never be combined, partially because of fees. Yes, you can save more money in a tax deferred account tax efficiently than maybe in a brokerage account. But in this particular case, that cost is 2.25% per year for these separate managed accounts. Basically, they're so expensive, they can't even call them mutual funds. Inside an insurance policy, they're called separate managed accounts. So in this particular case, you can take out the GVUL policy. Delta's paying those premiums. There might be a little cash accrual, but just don't add anything extra. By adding anything extra, you start trying to invest that money. It doesn't make sense. Quite honestly, this is all, you'd be much better off just having a tax efficient ETF portfolio and growing that than having the tail or the headwind of a 2.25% fee inside your life insurance policy. So yes, we endorse switching, but we don't believe that this is a proper way to be saving for your future. I joke in one of our podcasts recently, we talked about a Delta pilot who visited with a Northwestern mutual agent who was trying to convince him not to do the market-based cash balance plan. Obviously, this is a few months ago. And then not to save into his 401k and to purchase a whole life insurance policy for everything. So the life insurance people they're all kind of the same in that whole life or universal life policy is a solution for everything. So just be aware of that as you're going into the policy and avoid the trap of a bad investment, but do take advantage of the policy. There is something else good too about it. Let's say you turn 65, you're done flying, but you have a terminal condition. Hopefully that never happens to anybody. But if that were to happen, you can continue to pay for this policy post your retirement to keep it intact, especially if there was a situation where you thought it might be used sooner than you would like. If you have any questions, reach out to us directly. You can reach me at casey@wiserinvestor.com. You can also click on the link below to book an appointment with us online. Thanks so much.